Good morning, Ron. Good morning, everyone.
Hi,
Welcome to
Kathy.
the Baby Boomer Investing Show. We're pretty excited today about this show. And I'm just wondering, Ron, do you think anybody did their homework from last time or
Well,
not?
my favorite student did not do her homework.
Uh-oh.
So, and I thought the homework was important. So this is part two of the first episode in season two. It's a follow up to what we did on the last episode because I gave four assignments.
Right?
You see, four, okay,
Four?
four assignments.
Four.
And my favorite student, my wife, Barbara, did not a single one of them. I know.
Did she get an F?
Well, I know why we're having troubles with sex.
You do? Oh, because she didn't do her homework. Oh, so you're
No,
holding
no, no,
back.
no.
I got
Actually, I saw her driver's license.
Yeah?
She got an F in sex.
Oh, for female. There you go.
Oh,
Well,
oh, is that what? Oh, okay.
female. Yeah, not fail.
That's
Yeah.
different.
Okay. You read
Okay.
it wrong. Yeah.
Yeah. So anyway, we're going to follow up here. This will probably be a shorter show,
Okay.
but I want to cover the four things. And before we do that, let's just review what we did on the first episode of season two. It's our 16th episode of the Baby Boomer Show. So maybe on the next slide, Kath, we can just review what we covered in that episode. I'm
Okay.
sorry, yeah, the one after that.
There you go.
So this is more about the rest of the story, but what we covered on that show was threats to the economy, and this is a slide that we actually used, I think, in the third show that we did, and we were warning about COVID-19 before it was sort of recognized as a pandemic, and there are other threats to the economy, the stock and bond markets. I'm going to talk about this, but I view that there's a bubble in the stock and bond markets, and I'm not alone. But I had an interesting conversation yesterday with a pretty smart guy who says I'm wrong, and certainly the market thinks I'm wrong because it keeps going up every day. So we're going to touch a little bit on why the market's doing what it's doing and why I could be wrong. So it wouldn't be the first time. So the other threat to the economy is the world debt. And there I recommend that viewers research someone who's done a lot of work revealing and doing an expose on how the central governments are creating this huge debt that this is incredible. And we're going to talk about him. Then the other threats, of course, are nuclear. North Korea still has their bombs, and Iran is still threatening to develop that. And then the trade wars, I think, have escalated now with China making everybody sick. So that's definitely going on. And then hyperinflation is certainly a concern in light of the debt. And then this professor I talked about too talked about Social Security and Medicare, and there's no doubt about it that they're forecast to run out of money. And that actually leads to one of the other topics we covered was, so can the U.S. run out of money? They just print it. They can't run out of money. Just print some more.
Yeah, that's a super confusing fact, not only to me, but I'm sure to a lot of people. Why? How can they just keep printing money, printing money, and then saying that we're not in debt? How can that be?
That's an excellent point, and we're going to touch on that. It's one of the places we said to look to. And the other thing that's related to that is everything I'm reading now is as everybody's concerned about getting more COVID relief. Especially those people who have been unemployed and now their unemployment checks are back to what they were before being subsidized. That money's got to come from somewhere. So, bottom line is taxpayers are going to pay for that, but maybe not you and me, and
Yeah.
maybe not even our kids, and maybe not even our grandkids. So we're looking at obligations that we're making on behalf of people who probably haven't even been born yet, and that's really what's going on there. So coming back to that slide, Kath, the other thing we covered in the last show, we went out on the limb and made a forecast for what the stock market of the 2020s was going to do for the whole decade. And on the far right part of that, the red bar in the far right there, are either further there, that one, way far right, that one, that's the bar. So we have a formula that a lot of people use. It's actually a tautology. But given the current level of price earnings ratios, current level of dividends, expected earnings growth, all those factors are cooked into the forecast. Um, that formula has been a pretty reliable formula in the past, and right now it's saying that on average over this decade we'll take a 1% loss, and that makes it look like the 2000s, the decade of the 2000s, which people who watch this, if they're boomers, they'll remember that, and it was not a pretty decade. Certainly, the last decade, the 2010s, was very nice, one of the best decades ever, and that's what's sort of propelling this forecast. Is we come off a real threat to the economy and to the stock market in 2008, 2009, and have done very well. And I think that's really caused us to be in a situation right now where things are really very pricey. So on the next slide, the 4 assignments I gave to viewers, and I think they're all important. I recommended that you look up Dr. Lawrence Kotlikoff. And Kathy, you put this on the websites too, so people who went to see the video would see these 4 assignments. And maybe some of them did do it. I hope they did. But we're going to talk about Dr. Kotlikoff. And then when this thing came up that he was the first one I read. I think others are saying it about the true debt being not just the official debt, but goes beyond and what he calls off-balance sheet debt, and it's huge. And who's going to pay for that? And printing money certainly comes to mind. We're going to talk about how that's done and what it means. And then I recommended this publication that I found really helpful, and I think others would. It's called Peak Prosperity. And it covers a lot of things that you're not going to hear on the normal news. It's not all negative. I think it's fairly well balanced. If you wanted to compare it to maybe a TV show, maybe it's like Fox News, but I'll say some of the stuff they go into is not even on Fox. So it's like things you might never know if you didn't get the Peak Prosperity. And then the 4th lesson is the SmootHawley Tariff Act. And I'm going to talk about that, but bottom line is this sort of current trade wars all seems good, and it might be good if we're being taken advantage of, but I think we need to be careful. And there's a lesson that happened back in the Great Depression that should not be ignored. So we're going to talk about all 4 of these. And we'll start with Dr. Kotlikoff, Kath, on the next picture. And this is his picture. He's a professor of economics at Boston University. I think really well known. And in the top panel here, we talk about, and this is from his website, about all the things he's concerned about. Economic problems, real wage growth, miserable inequality. By the way, the inequality thing I've been reading more and more about too, and I think you probably have, but the difference between the top 20% and the bottom 80% has really exploded in the last decade, largely due to quantitative easing. And let me put it another way, most of that new money, $5 trillion and counting, ended up with the wealthy people. So Dr. Kotlikoff, if you Google him, you're going to find a lot of articles, but most importantly, he starts out with this idea that the official debt is something like 22, 23 trillion dollars. And if you go to the debt clock, you'll see it's increasing every day. And gross domestic product is roughly that. It's a little less, maybe $20 trillion. So the official debt is 100% of gross domestic product, which is troubling. It's alarming. But if we add in the off-balance sheet debt, namely Social Security and Medicare, the total debt is $100 trillion, 5 times GDP. And he goes to great extent to say why that is and why we should be concerned. But none of us are concerned. we're,
You say it, but you're right. No, nobody is concerned because
well,
it's
it
not
makes
me,
your
it's
hair
not
hurt
me.
to think about it. And the right figure for the U.S. and
Yeah.
actually for the rest of the world is per capita. We each owe $200,000, and I know, Kathleen, our last show, you sent yours in, so you're done,
Yeah.
and we all appreciate it. But again, I encourage you to Google Dr. Kotlikoff. I think you'll learn a lot from him. I actually met him on the phone. He seems like a very nice guy. And then the next assignment we gave you has to do with, so just print more money. It's it was $100 trillion, print another $80 trillion, just pay that off. And that's on the next slide. So the next assignment was to, if you Google these words, we actually showed this next slide in another earlier show. But basically what happens is the Treasury issues bonds, bonds and Treasury bills, Treasury notes, Treasury bonds. And historically, those bonds were bought by U.S. citizens, by foreign citizens. They're ready takers. But currently, most of that new money is being bought by the Federal Reserve. So over on the right-hand side, the Treasury is issuing the bonds, the Federal Reserve is buying them, and it's just, it says robbing Peter to pay Paul. So, the checks that you've gotten before say U.S. Treasury on them, but what's really going on is we're creating this accounting that lets us continue to go on and spend money. And there's a theory that we've talked about a little bit. It's called modern monetary theory. And I think it's what triggered the quantitative easing that started in 2007, 2008. And modern monetary theory says that if you can print money and you've got a problem that's solved by money, you should do all of that you need to do. And you need to one of the monitors you can do is employment. Once you've got full employment, you can stop printing money. There are other measures to sort of guide you, but that theory basically says if it ends up starting to cause inflation, which that's the whole idea about inflation is too many dollars chasing too few goods, you need to be prepared to take that money back out of the economy. And the tool for doing that is taxation. So I think I've got that right. I've been told I don't have it right, and I've got people, believe it or not, sending me 100-page articles saying, read this article and you'll get it right. I can't read 100 pages, certainly not of the techie stuff. I don't know if anybody else can.
Well, I'll tell you what, Ron, you're right.
Yeah, thank you. I needed it.
There. That came from above.
Right. So far, quantitative easing didn't cause inflation. And on the next slide, we're going to talk about why that happened. Again, so if you listeners will Google monetizing the debt, you won't see this. Anyway, I'll talk about it. So first of all, there are 3 phases of quantitative easing, and in total, they put about $5 trillion, not so much into the economy, but it mostly went into the bond market to keep interest rates low. And what most people sort of haven't thought much about, but I'm pretty sure this is true, the people who sold the bonds went out and bought stocks. So that money went into both the stock and bond markets. And when you say there hasn't been any inflation, the reason for that is that money didn't go into consumer goods. So the measure of inflation that we normally use is the consumer price index. And that quantitative easing did not move the CPI needle because that's not where the money went. So we've really had inflation, but we've had it in stock and bond prices. And the economist's word for that is money illusion. So people really think they forgot that a dollar in the stock market is worth less today than a dollar in the stock market 10 years ago. And that's called money illusion. So just be aware that the stock and bond markets are being manipulated, for lack of a better word. It's a strong word, but close. And that's part of the reason why those prices are so high. The COVID relief so far has put another $3 trillion into the economy. And that much of that has gone to people who needed to spend it for rent, for groceries, for normal everyday goods. And that is starting to move the consumer price index, and people are seeing that. Uh, what I've been hearing more and more is it's actually moving the cost of living, the cost of owning a house and renting a house. So that's happening, and then there's probably another $2 trillion, depending on what the regulators decide to put in. But it'll probably be another $2 trillion that will go in and move that needle. So I'm only saying this about the CPI needle because I think modern monetary theory, um, at least from what I heard, is measuring inflation using the CPI. And when that does happen, which many believe it will, the remedy to curtailing inflation is to raise taxes. And maybe if the Democrats get in, that will happen. I mean, many people think that will be one of the results of a Biden win. So just be aware of that. So a lot of what we're doing here on the show is sort of alerting baby boomers to things that they need to watch. And at the end of this, I'm going to remind them what they should be doing. So the next thing I want to do is talk about peak prosperity, Kath, on the next slide. And this is a publication. I got an email probably a year ago just promoting this thing, and it's free. I think there's opportunities to sign on for a more senior subscription. But I've never done that. I found that, well, I don't want to discourage you. If you like it, by all means, buy the better thing. But on the next slide, I'll give you some examples from last Sunday's email. So each Sunday, I'm sorry, Saturday and Sunday, it's probably Saturday it comes out, there's about a dozen of these things. And most of these you can see are not things that you would see on TV. Psychology of inequality, dividing it with COVID-19. The Fed is playing a game that they at this point they can't win. So many people have said, with all this quantitative easing, with all this money in the economy, they might be able to lower interest rates below zero, like Japan has. By the way, this is another thing that people say is, look at Japan. They've done that and they're okay. Well, they're not okay. They haven't been okay for a decade. Their economy has been extremely slow, and they're seeing signs of the repercussions of following what sounds very much like modern monetary theory. What happens if there's a second lockdown? I think New York has done a second lockdown now, pretty sure. So these are things that I think you'd enjoy reading, and they're very educational. Then the fourth assignment is on the next slide. And there's sort of a notorious attempt right as the recession began to isolate the U.S. And it was very protectionist, and to protect America sounded like a very good thing to do. And the act passed. It's the SmootHawley Act of 1930. And the two drafters of the act are named, the last names are Smoot and Hawley. But in the next slide, if you Google it, you should find this. It's really easy to find. It's by a website called The Balance. And the post-mortem on SmootHawley is all it really did was worsen the length and the depth of the Great Depression. It isolated us from the rest of the world. The rest of the world retaliated. Some say that it was the very beginnings of what led to World War II. And I think part of that was we hurt the Japanese so bad that they just had to come at us with all they had. And that was it was part of the reason that they have to do a world war. So the moral here is I believe Trump in his heart is trying to undo some unfair tariffs against the U.S., and that's all good. But I don't think, I think we need to be careful about how much of that we do. And certainly with China, because on the next slide, Kath, I think this is revealing. So this takes a little bit to read. So the inner circle here is the current gross domestic product. So China's GDP is 25 trillion right now versus our 20 trillion. The red ball on the right and the blue ball on the right. The red on the left and the blue on the right. India, in the meantime, is far less. It's about half of the U.S. At $10 trillion. But economists are forecasting that at the end of this decade, in 10 years, China's economy will be $64 trillion, twice the size of the U.S. at $31 trillion. And equally amazing is also India will come to be even a larger economy at $46 trillion. So I think if we start to isolate ourselves from these growing economies and their goods, it's not going to do us any favor. And what happened, by the way, with the SmootHawley Act is it hurt American farmers. So foreign countries needed to pay more for U.S. corn and U.S. grain and livestock, and that meant that the rest of the world figured out how to live with non-U.S. Groceries, basically. So those are the four things, and I want to come back to the way we finished the last show on the stock market. And I said this, and now I've been talking to people who say you're wrong, prices aren't too high. By the way, I went to the University of Chicago, and they teach efficient markets. And the idea of an efficient market is whatever the price is the right price, because it reflects the collective thinking of everybody who's there. Everybody reads a lot, so whatever the prices are, they're right. Now, the thing about that is we have seen bubbles. And bubbles, so how can the prices be right? And then, 1 month later, they're 35, 40% lower than they were. People call that.
Right. Didn't we talk about that before on one of the shows? Because I know that I was saying, well, to me, the prices are too high, but to somebody else, they might be right. I think it's also a matter of perspective.
It is, absolutely.
Too.
And we did talk about this on the last show. I'm sort of reviewing. I'm going through 3 slides from the last show. So on the next slide,
okay,
we said the bubble is going to burst. First of all, we started with the economy's in trouble, but then we said that the stock market bubble is going to burst. And it's going to burst so that we're going to lose 1% per year in the stock market. And we said it could happen quickly. And if it happened really fast, like say in a couple of months, 2 months, the market adjusted, it could go down as much as 40%, 40, 50%. And then the rest of the decade would be better. But a 1% loss per year on average. And we talked about the FANG stocks, the Facebook, Apple, Amazon, Netflix, and Google. Those are driving the market. And my analogy is on the next slide, Kath. And this, I just thought that it might be fun to Google designer jeans. And I didn't search for this at all. I just I got a Macy's website and said, so what are you guys asking for designer jeans? And this is an example of many that were more than $1,000 for a pair of jeans. And I don't know about you. I look at that and I say, I don't think that's a fair price. But yet it explained to me yesterday that the stock market is fairly priced because interest rates are so low. And there's a legitimate case for that. So the idea about pricing a stock is what you're buying are the future earnings of that stock. And what investment professionals do is they forecast those future earnings, and then they discount them back to today to come up with a price. So the idea is I'm buying the stream, and to get it back to today's terms, I need to use a discount rate. And today the discount rate is maybe as low as 2%. Now, it's been below 2% for at least 3 months now. But the stock market keeps going up. And the other thing I'll say is it was 5% in 2008. So if you would discount at 5% versus 2%, that will increase the value of the stock by about 20%. Wait, let me check my notes because I might have said it wrong. Oh, this is more complicated, so you have to look at my notes. So if you went from 5% to 2%, that increases the value of the stock by 50%. It's gone from recently from 2% towards the end of 2019 to let's just say it's a 0.5%. It's almost zero. That would increase the value of the stock by another 15%. So I think that discount rate thing is true, and is part of the reason why stock prices are high, but they're going up every day. And interest rates aren't going down every day. So there are other things pushing this. And one of the things I read recently is it's called the greater fool theory. And so presumably really smart people see that the prices are high, but they're going up and they're going to keep going up. And I'm smart. I'll know when to get out. And I'm just going to ride on the tails of the greater fools. Now,
Yeah.
by the way, that's not too unlike what was going on in the housing bubble in 2007. Do you remember
Okay.
that? I mean,
Yeah.
people were buying houses. They didn't put anything down. Because
Yeah.
everybody believed that the only way housing prices could go was up. Do
Yeah.
you remember that?
Yeah, I do. I
Yeah.
remember.
And we know what happened then. So,
Yeah.
uh, so I'm willing to admit that I'm certainly not in the majority, but I think I'm in a large minority of people who think that we've got a bubble and we should be concerned about it. But now let's talk about baby boomers and why, for them, they shouldn't bet against me. And that's on the next slide, Kath.
Okay.
So believe it or not, our very first show, we talked about the 4 pillars of smart investing. And I want to come back to that. And we'll go to the next slide. And we showed many things on the first show, but one of the key things is that boomers are in what's called the risk zone. And even if this bad thing doesn't happen, and I think something's reasonably bad going to happen in the next decade, but the left picture here, the number one smart thing to do in the 4 pillars of smart investing is not even a little profound. The number one thing to do is to save enough. And there's no investment strategy or anything else that's going to make you whole if you don't save enough. So that's critical. But then the second thing you need to do is to not lose those savings. And that green line at the top sort of shows you how important it becomes to protect those savings. So early on when you're young, you've just saved a little bit. And if you lose that, you've got a lot of time to come back. You can do a lot of things to make that money back. But as you get close to retirement in what we call the risk zone, your savings have reached their peak. And then beyond that, you're going to start spending those savings, and those savings are going to go down. So what that means for the 4 pillars is the risk control needs to sort of adjust and move to be more defensive as those savings become more dear. And that's the red line underneath. So baby boomers should not be taking much risk at all now, regardless of whether they think the stock market's going up or down, because nobody knows. And the research basically is saying that the average boomer is 60% in equities and 40% in bonds. And we had a whole episode about that, Kath, about the consulting profession and how it's evolved through time. But the 60-40 solution is so entrenched in investment advice that I think that's what's going on here, that the the, the wealthier boomers are getting advice, and we've encouraged them to trust but verify. If they're 60-40, they need to really have a serious discussion with their advisor, because that's a pretty risky position. That's the position that lost more than 30% in 2008. It's roughly the way target date funds were invested for people near retirement. So our warning is there. And over to the right, what we're really saying is, it might not happen this year or next year or the year after that. But if you're going to bet on it 10 times this whole decade, it's probably not a good bet. Somewhere in this next decade, with the economy being in the dangers it is, with the stock markets being at very expensive levels, the odds are pretty good that sometime in this decade, we're going to get hurt. Now, the youngest boomer just now entered the risk zone. And we define the risk zone as the 10 years before and after retirement. So that young boomer has got roughly 20 years to try to get through with his savings intact, or her savings intact. So I think that's critical. And then the last slide, Kath, we end each show with ways boomers can help themselves. And one thing I think I should say here is probably easier. Rather than write any of these down, if you just remember, if you Google the Baby Boomer Investing Show, it will come to the top of the list. If you Google 8-Stage Robo, that's the firm that I started to help baby boomers, that will come to the top of the list. If you want consulting help, we have Glide Path Wealth Management. That will come to the top of the list. And then also, if you're a fiduciary associated with a 401k plan, the smart funds are collective investment funds. So there are a lot of ways that we can help, and we're here to help. And we certainly appreciate you watching the show. So that's it for today, Kath. I think the next two shows is to sort of get our audience wanting to watch, maybe. I'm going to do something on the various ways that people can save for retirement. So I'm going to talk about individual retirement accounts, 401k plans, Keogh plans, simple plans. This is sort of setting the stage for how people can save their money. They can certainly put it in the bank too. But and then the episode after that will be November 3rd, and we're going to have a guest who's an expert.
That's election day?
We're going to have it on election day.
Okay, exactly. All right, yeah. Cool.
So we probably won't know the results of the election for a week or two after that, the way things are going. But I thought that would be a great time to invite an expert in to educate us on what we can be prepared for, regardless of. I think he'll talk about, what happens if the Senate and the House both go one way or the other.
Yeah, right.
It is all those things that are going to affect all of us, I think, and certainly boomers, given that they're in the risk zone, I think are much more sensitive to these things. So should be an important show. The next show should be interesting, I think, but not as important as the November 3rd. Yeah.
Well, I'm sure they're all interesting, so it's all going to be really good. Okay, well, thank you very much. This was a great show, and we will see you in 2 weeks.
Great. Thank you, everybody.
Thanks, everyone. Bye.